Hey, Andy, who wants to talk about mutual fund capital gain distributions? I know I do. So, what are they? Here we are. It's the end of February 2020 as of the making of this video. And if you're doing your taxes, or you're soon to be doing your taxes, and you have mutual funds in a regular taxable brokerage account, not an IRA, not a Roth IRA, not a health savings account, but a regular taxable brokerage account, chances are you got some what's called capital gain distributions, likely in December of 2021, and those distributions are taxable. Now, you may not have even noticed, because generally you don't actually get cash out or any money sent to you. You still have as many total dollar amount of mutual fund holdings as you did before the distribution. But when the distribution happens, it is a taxable event in the year it happens. So even though you never sold any of your mutual fund, chances are you have a taxable capital gain distribution that you have to pay tax on for 2021. So what is it? Let's get into it. First, it's important to understand. Let's think about the example for a basic single share of stock, for example. I think we all get this. You buy a share of stock for $5, you sell it later for $8, you have a $3 gain, and you have to pay tax on that gain. Again, assuming you bought this in a regular taxable brokerage account, not a qualified account like an IRA, Roth IRA, HSA, etc. This whole discussion is about regular taxable brokerage accounts. So you buy a share of stock at $5, sell it for $8. That $3 you have to pay a tax on, because that's income to you. It's a gain. You have to pay tax on it in the year you make the sale. That's when you recognize that gain. And if you held the shares for more than 12 months from the time you purchased it, and then you sell it, that'll be a long-term capital gain. And that matters because long-term capital gains are taxed at lower, more favorable rates than short-term capital gains, which are taxed as ordinary income. Your normal tax brackets and rates, if you will. So short-term capital gain simply means you sold the position within 12 months, including 12 months from the time you bought it. So if you held it 12 months or less, and then you sell it, it'll be a short-term capital gain. And then long-term, again, you held it for more than a year. So that's a regular share of stock. Obviously, the taxation of it is when you sell it. You control when you sell it, and therefore you control when you pay tax on that gain. So it's a mutual fund. A mutual fund is basically you and thousands of other people all put money into this pot, into this pool. There's a fund manager that then uses that collective pot of money to go out and buy a bunch of different stocks, bonds, commodities, whatever it may be. You, as the fund holder, you own a slice of that pot. So you and everyone else who puts money in all own a prorated share of what's in that pot. And that proration is determined based on how much money you have in the pot versus everybody else. So for example, you put in $1 into you buy $1 worth of this mutual fund, and other people collectively put in $999. There's $1,000 in that pot in total. You own 1/1000th of it. That's your share. So the way the law is structured for mutual funds, any economics the fund has, the pot of money has, whether it's dividends, interest, or capital gains from that pot selling something, those all have to get passed on to you and all the other fund holders based on your prorated share of that whole pot. So now you can see where I'm going with this, I think. Even though you don't sell your holding of the fund, like with a stock, like I said, you control when you sell it, and therefore you control when you recognize the tax of the gain. Not the case with mutual funds. Yes, if you sell the fund for more than you bought it, then that sale will be a taxable gain to you. But even if you don't sell the fund, you hold it for years, every year, most mutual funds will pay out the share of the gains that were made within the fund will be passed on to you, the fund holder. So why would a fund have gains in it? There's a few reasons. One is if it's an actively managed fund where the fund manager is consciously, proactively trying to pick winning stocks versus losing stocks. So there's buying and selling going on within the pot. Well, that right there is going to be capital gains if any sales are done at gains. So if the fund bought a stock for $5 and sells it for $8, the fund has a $3 gain. That $3 gain has to get passed on to you and all the other shareholders of the fund in the year that the fund sold it. Fairly straightforward, right? So they simply sell something for whatever reason, they like it or they don't like it anymore, or maybe the fund, its investment strategy is such that no position can be more than 10% of the fund. So maybe there's 20 stocks in the fund, one stock does really well and kind of gets a little outsized relative to the others. That stock now is more than 10% of the fund. The fund manager has to sell some down to get it below 10%. in the act of selling that's going to generate a gain. That capital gain is going to get passed on to you, the fund holder. So those are fairly simple to understand. Even index funds have the same thing. Now, there's generally less buying and selling within an index fund because the purpose of the fund is just to mimic or replicate the holdings of some index, like the S&P 500, for example. But even though the holdings are fairly static, it doesn't mean there's still not some changing. So the index itself sometimes swaps out some names and adds others into the index. As that happens, the fund that's supposed to replicate the index has to do the same. It has to sell out of the stock that is no longer in the index and buy the stock of the company that is now in the index. So in the act of selling, there could be capital gains. Again, that capital gains passed on to you, the fund holder, in the year that the fund made that sale. Now, what's kind of more I don't want to say painful, but when these capital gain distributions are even less palatable is it's quite feasible that the value of the fund goes down. Let's assume stock market drops during the year. So the fund value goes down because all the securities and stocks the fund owns are going down in value. So your holding in the fund, your value in the fund decreases, yet you still may get a positive taxable capital gain distribution thrust upon you that year. Not because of any of your doing, just again because stuff was sold within the fund. So how and why could that happen? So when you're a fund holder, you own shares of a mutual fund and you want out, you redeem your shares directly from the fund company. Even if you're doing through a broker, you're ultimately still redeeming your shares direct from the fund company. So you have $1,000 of a mutual fund you want out, you tell the fund manager company, I want out, here's my redemption request. They typically cash you out, at the end of that day, you get the money the next day. So they need to pay you out, you hand over your shares, basically, you give up your ownership, they give you back $1,000 cash. Now, if the fund has $1,000 cash sitting in the pool, well, simple, it'll just give you $1,000 out of that pool, you're good. But what if the fund doesn't have enough cash to meet your redemption request and the redemption request of everyone else? Let's assume stock markets drop, people get scared, they run for the gates, they all want to redeem, or lots of people want to redeem. The fund is going to have to pay out more cash than it has. So that means it's going to have to sell things to generate cash to give those cash out to the people who want to redeem. So even if stocks drop, the fund value drops, people want out, people want to redeem, the fund is forced to sell things to generate cash to meet redemption requests. And in doing so, if they're selling things at gains, well, there you have it. There's another form of capital gain distribution. So that can be especially annoying, right? The fund value drops during the year because prices come down and you're getting a taxable event passed through to you to none of your own doing, it just simply because stuff was sold. So basically in that case where sales in the fund are happening to meet redemptions, it's the people who are still staying behind, still holding the fund, are kind of left holding the bag, paying the tax on the sales that happened as a result of people who redeemed out. Which doesn't really seem fair on the surface, and frankly it's not, but there's really no way around it. That's simply the way mutual funds operate. Just be aware of it so you're not surprised if and when it happens. So that's what the distributions are, capital gain distributions. Now, you'll see them reported on your 1099, your consolidated 1099 you get from your brokerage account custodian at the end of the year. Line 2A will say capital gain distributions. What exactly is that? So remember I said there's long-term and short-term capital gains. If the fund holds something for more than a year before it sells it, that'll be a long-term capital gain. If the fund sells something within 12 months, including up to 12 months from the time it bought it, that's a short-term capital gain. Now, long-term capital gains at the fund level are passed through to you as long-term capital gains on your own personal tax return. These long-term capital gains by the fund are what's reported on line 2A of your consolidated 1099. Now, whether you held the fund for 1 month or 10 years or any point in between, or 0 days or 10 years, that capital gain distribution will always be taxed as long-term on your tax return. So just to recap, you've only owned the fund 2 months, let's say, right? Less than a year, so you may think it's going to be short-term. Doesn't matter. If the sale in the hand of the fund was long-term, meaning the fund held the position more than 12 months, that capital gain distribution will be passed through to you. You will pay long-term capital gain tax on it, even though you've only held the fund for 2 months. So nice little feature. If it's a short-term capital gain by the fund, so the fund held it 12 months or less before they sold it, that'll be a short-term capital gain distribution. That's actually reported as a dividend on your 1099, which should be in line 1A, I believe. That will not be in line 2A. Again, line 2A will always be just the long-term capital gains of the fund. And those will always be taxed as long-term capital gains to you. the short-term capital gains, you won't even really see it unless you dig into the back pages of your 1099. They're just going to get lumped into the line 1A dividends on your 1099. They'll look and feel like any other ordinary dividend. You're not going to know the difference again unless you dig through the back pages to look at what makes up that total dividend line. So that's how they're taxed. Why am I bringing this up now? Well, 2021 was an especially good and bad year for capital gain distributions. It was a good, meaning there was a lot of capital gains distributed. So all else equal, yay, everyone made money. Not everyone, but if you got a capital gain distribution, it means you made some money. And it was a lot were paid because 2019, 2020, and 2021 were really strong years in the stock market. So a lot of funds had a lot of positions they wanted or needed to trim down because so much has gone up. Therefore, all else equal, there's that many more capital gain distributions to get passed on to you, the fund holder. That's one reason. Another reason, this is particular to one company in particular, it's public news, so I can say Vanguard has target date retirement funds. Kind of set it and forget it. You buy a fund, it automatically allocates that fund to different Vanguard funds, a mix of stocks and bonds and what have you. Even those pass through capital gain distributions. But what was unique about 2021, long story short, and I'll put a link to the article in the notes to this video. There's a Wall Street Journal article. Basically, Vanguard had two different classes of funds. There's a retail class and the institutional class. The difference is retail class is for smaller investors that don't have a few $1,000,000 to put into the fund. That class has higher fees, higher expense ratios than the institutional class. I forget what the minimums are. I think it was $5 million, maybe I can be wrong. But if you have at least $5 million to put into this one fund, you'll get lower fees as a result. That's the institutional class. All else equal, people would rather be in the institutional class, but if you don't have enough money to put into it, you simply can't. So Vanguard lowered the minimum in 2021 for the amount of money you needed to buy into the institutional class. So more people from the retail side now had enough money that they met the minimum. So what happened was people redeemed out of the retail share class, bought into the institutional share class. In the process of redeeming, remember what I said, if there's more redemption requests than the fund has in cash, the fund is forced to sell things to generate cash. That's exactly what happened. So because of all the people redeeming to leave retail to go to institutional, the people who remained as the retail fund holders were left holding the bag of paying the tax bill of the redemptions that caused the sales of people who were leaving to go to the institutional class. So again, doesn't really seem fair, and it's not, but it is what it is. Now, while it may sound bad, like, hey, I got to pay tax all of a sudden, well, you actually got something for it. You got the distribution. It's just sort of forcing you to recognize some of the tax on it sooner, as opposed to if you just held the fund forever and sold it on your own accord and pay tax then. You're kind of paying off some of the tax along the way. Again, you don't control when, but it's not like you're really losing anything. And these capital gain distributions neither create nor destroy wealth. This is where things get a little technical, but if you have a fund that's $10 per share and it pays a $1 capital gain distribution, what's going to happen is you're going to have a $1 taxable distribution you have to pay tax on during the year, and all else equal, the fund price, the share price, is going to drop from 10 to 9. So you may say, wait, doesn't that mean my holdings just dropped by 10%? Well, no, it doesn't, because by default, mutual fund dividends and capital gain distributions turn around and get reinvested into more shares. So what happened is you owned one share at $10, let's say, so your total value is $10 of holding. You get paid a $1 distribution, so now you have $1 in cash, and then your fund price drops to 9. So you now only have $9 worth of fund and $1 in cash. You still have $10 of total holding. Again, wealth is neither created nor destroyed. And what happens is you don't actually see the cash. And in almost all cases, by default, again, these distributions are turned around and pumped into buying more shares. So you still have one share that's now worth $9. And with this dollar of distribution you just got, you're actually buying a new fractional share. So however much a dollar will get you when it's $9 a share, I don't know, I can't do the math that quick in my head, roughly a tenth of a share, right? So now you have 1.1 shares, let's call it, after the distribution's reinvested. You have 1.1 shares at the new lower share price of $9. That still equals $10. So you didn't make or lose money in this process of the distribution. What did happen is the taxation of things. You're realizing some of the taxation of the gain in the fund, as opposed to, again, like a stock. If you just hold it, sell it later, you control when you realize the sale, when you realize the gain, when you realize the taxation. With mutual funds, some of the gains on the taxation is passed through to you on a year-by-year basis outside of your control. All right, that's it. I hope you found this helpful. If you like it, definitely please give a little thumbs up, little like, and please share if you like it. That's all. Thanks for watching. I'll see you next time.